would sacking the Fed chair mean for the US economy and the dollar? President Trump now says he isn't about to sack Fed Chair Jerome Powell, but reports earlier in the week claimed he'd written a letter dismissing him and asked Republican lawmakers if he should send it. That caused a brief slump in the dollar and a spike in US borrowing costs. The White House alleges Powell misled Congress over a $2.5 billion renovation of the central bank's headquarters, which could potentially give them cause to fire him. Well, Chris Turner is global head of markets at ING. Chris, President Trump has been railing against Chair Powell for a while, but markets are clearly taking the prospect that he could be sacked more seriously this week, aren't they?
Yes, as you say, we did see a pretty sort of sharp drop-off in the dollar. It's interesting that the dollar fell across the board against, the safe haven currencies like the euro and yen, but also against emerging market currencies as well. The takeaway that US rates would be a lot lower under a Trump-appointed Fed chair.
Should markets assume that, though, that a Trump appointee would slash rates as aggressively as the president wants?
Yeah, there's a lot of debate over that in terms of how the committee works, in terms of trying to seek a majority or a consensus. And perhaps the fact that the dollar didn't fall even harder when we did get that report suggests that there could be some restraint from the rest of the committee. But I think the big takeaway, though, was it was a shock. The dollar did fall. Gold prices rallied. Equities initially sold off. But I think over time, and we've been discussing that at ING, that asset classes like commodities and equities will probably be seen as an inflation hedge if interest rates were cut perhaps more than they should be.
Does that mean then that you would expect a serious hike in inflation?
That would be the risk, yes. I mean, we'd have to see where inflation is in the first quarter of next year, because that would be when Powell, his term kind of ends. Obviously, over the next 3 or 4 months, we think US inflation is going to tick higher as tariff pressure comes through. So that could be a dangerous cocktail if inflation is ticking higher at the same time that a new Fed chair is appointed, or the market is worried about that. So that would be a risk to higher inflation. And as you say, a lot of focus on the long end of the bond market under those circumstances.
Yes, and wouldn't that mean that if investors demand a higher yield to hold US debt, interest rates would actually be going up?
No, exactly. Yeah, bond yields would be going up. And I think the question would be, for equities, on the one hand, you get lower kind of interest rates at the short end, which should be good for growth. But if the market is worried about what's going to happen at the long end of the curve, whether inflation is out of control and it triggers an exodus from treasuries, as was the case in April this year when bond prices fell very sharply, that could blow back as a negative for equities. So a lot of uncertainty. And I think financial markets, even though it seems very tempting to have lower rates and a more dovish governor, I think they like the independence of the Fed that we've got at the moment. And I think they like what Powell is doing.
What if the president appoints a new chair, a shadow chair, if you like, well before the end of Powell's term, and then we have two people expressing contradicting opinions?
Yeah, I think that would just increase, the pressure or the speculation in market that when a new chair is appointed. So remember, in January, I think it's Adriana Kugler, her term ends as governor. That will be the first opportunity for the White House to appoint a new Fed governor. Perhaps, is it going to be one of the Kevins, Walsh or Hassett? Is it going to be Scott Bessent, the Treasury Secretary? But that would be the opportunity for President Trump to get a new governor in that could potentially become the chair in May. So a lot of as you say, if there is a shadow chair there, pressure is just going to increase on Powell. But I think he's going to think about his legacy and will continue to stick to the view that we're not ready yet to cut rates. But it will move, though, if inflation isn't as bad as expected, or if there are any clear signs of the deterioration in the labour market.
Looking forward, then, what do you expect all this to mean for the dollar?
Yeah, so ING, we think, after a very big fall in the dollar in the first half of the year, like 10 to 12%, we think there's a bit of stability now. We think inflation is going to head higher in the States for the next 3 months. US interest rates at the short end might move a little bit higher, so a little bit of dollar stability. But by year end, the dollar will be under pressure again. We look for the Fed to cut rates 50. That speculation over Powell is going to be weighing on the dollar. And seasonally, in December, it's generally the weakest time of the year for the dollar.
That was Chris Turner of ING. Don't forget, you can watch more videos on Reuters.com.